In a recent video, I explained why I believe investing is key to affording the retirement that you really want. And you can find a link to that video in the description below. One of the main reasons for this belief is whether you're still accumulating your retirement savings or already spending them, the ravages of inflation will seriously impact what your money will buy in the future. So you need to find a way to secure an increasing income due to inflation, as the real value of your money is going to decrease over time. It's about maintaining your buying power to give you the best chance of your money outliving you instead of you outliving your money. Running out of money is really not a position anyone wants to find themselves in. And over the last 30 years, I've studied a lot of academic research and the lessons are clear. Investing in stock markets is an excellent plan for meeting long-term goals. So if investing is the answer, why don't more people do it? And what are the obstacles to a successful investment experience? And how can you overcome these obstacles? This is going to be the first of 3 videos on tackling the obstacles to investing that I see, and I'm going to discuss 4 of the 10 most common obstacles I've encountered in my work as a financial planner, helping people plan for their retirement. The first obstacle people put in front of themselves is the belief that I'm too late and the train has left the station. Only just recently I worked with a client and he just said to me, "I wish I'd come to see you sooner." And it was true. I could have made a serious impact if he'd come and seen me 3 or 4 years previously, prior to retirement. But it's never too late. It's never too late to get skilled up on this stuff and make an impact on what your future retirement income is. It's also never too late to be an investor. The sooner you start, the sooner you start to reap the rewards of that investment experience. The latest figures I've got about Warren Buffett and how much he's worth. The figure I had quoted is 84.5 billion, and I'm sure that's changing all the time. But out of that 84.5 billion, 81.5 billion of that wealth came after his 65th birthday. That's 96% of his total net worth. That is the benefit of compounding. That's the benefit of investing early and staying invested and letting the growth grow. We all understand R rates now. We all understand compounding of, the COVID-19 virus. And, we saw it compound on itself. Well, you can benefit from that same compounding when you become an investor. The next obstacle I come across is when it comes to investment advice, I don't know who to trust. You're absolutely right. And there are a lot of charlatans out there giving you advice about what's going on. Here's just some of the scams that I've come across in my time. Barings Bank going bankrupt, frauds all over the place, Neil Woodford, Elizabeth Holmes and her kind of high-tech company that everyone invested in the US, Maxwell running off with pension funds. It's difficult. So this is why you've got to become a little bit skilled, a little bit wise, a little bit aware of, if it's too good to be true, it probably is. So do your research in, if you need advice, of who you're going to take advice from. And maybe don't read out of the newspapers. The newspapers are trying to sell news. They're trying to sell adverts. They're trying to get you to purchase. And they're always trying to have a story. I call news, negative events, world service. Do a bit of research and look at what's always worked and will continue to work. In my view, that is investing in well-run companies of the world. Over the last 100, 120 years, the data shows that doing a well-diversified portfolio will give you the return that you need to have a successful retirement. The third concern I hear is, I'm just afraid I'm going to lose it all. If you have a well-diversified portfolio and you're not just trusting 1 or 2 fund managers and you're holding maybe 10, 11,000 shares in well-run companies of the world, the idea that if all of those companies go bankrupt and disappear, we've got bigger problems. That means the banks you've invested in, that means all the companies who are serving you and providing you with goods and services have disappeared. In our current world, hopefully that's highly unlikely to happen with a well-diversified portfolio. So if you go down the concentrated investment route, 7 or 8 different companies, then of course, one of those companies going bankrupt or disappearing from the high street or from the market it's serving is actually quite likely. That could happen. Well-spread investments in lots of different asset classes historically has given you the return that you need to produce a growing investment which hopefully grows in line with inflation or better than running in line with inflation. The fourth and final obstacle I'm going to address in this video is the concern that it's hard to figure out when to get in or out of the stock market. And of course, if you're trying to do that, if you're trying to time the market, you're trying to decide, as I say, when you get in, when it's grown so much that you want to get out, because if the only reason you want to get out, of course, at that point is because you believe it's going to fall. And you'll either be right or you'll be wrong. But let's say it actually continues to go up. Well, then you've got to make a decision of whether you get back into the market and what point you do. Let's say that you get it right and you call the top of the market, and then you try and you sell up, and then you wait for the market to fall, and the market falls. Then you've got to make an extra decision, of course, of when is the right time to get in. Well, this is a pretty difficult thing to do. Let me give you an example of someone who tried to time the market. March 2008, bought 1,500 Amazon shares for $62, sold them 2 weeks later for $65.82 and pocketed a profit of $5,600. Fantastic, great timing. I only sold them because I was afraid the market would tank. I didn't need the money. I've done some figures. Based on the figures I did recently for a presentation that I recently run an investment seminar, today they would be worth around $5.3 million. Just the holding on to that investment and letting it run and being part of a diversified portfolio would have been the answer. So timing the market is particularly difficult. Trying to time the market is gambling, it's not investing. It's encouraged by marketeers who are trying to make us buy and sell on share trading apps. So there you have 4 of the 10 most common obstacles I come across when people trying to invest. Why not subscribe to be notified when part 2 in this series is released? It's coming soon. And thank you for checking out my YouTube channel. I really do appreciate it. I'm Justin King. I'm a chartered and certified financial planner. And my aim is to help people live successful lives. That often involves understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. And for now, I'm Justin King, helping you live your best life.